Friends, thank you for being here today. We are gathered here to discuss a subject that the mainstream financial media is largely ignoring, or perhaps willfully obscuring. If you are watching the nightly news or reading the headlines of the major financial papers, you might believe that the economy has achieved a soft landing. You might believe that the banking system is resilient, that inflation is under control, and that your retirement savings are as safe as they have ever been. However, those of us who have lived through the economic cycles of the past, the inflation of the 1970s, the savings and loan crisis of the 1980s, the dot-com bubble, and the great financial crisis of 2008, know that the official narrative rarely matches the economic reality on the ground. We prefer data over rhetoric. We prefer hard numbers over optimistic projections. And the data we are seeing today points to a mathematical inevitability that we simply cannot ignore. We are here to discuss the silent crash. It is silent because it is not yet resulting in lines of people wrapping around city blocks waiting to withdraw their cash. It is silent because it is happening on balance sheets, in closed-door board meetings, and in the algorithms that determine creditworthiness. But make no mistake, just because it is silent does not mean it is not catastrophic. This brings us to the evidence of the great devaluation, which is already visible in plain sight if you know where to look. If you want to understand the future of the American banking system, you do not need a crystal ball, and you certainly do not need to listen to the talking heads on cable news. You simply need to look at the hard assets that underpin the loan portfolios of our nation as banks. Let us look at a single, tangible example. Consider the AT&T Tower in downtown St. Louis. This is a massive 44-story skyscraper. For decades, it stood as a symbol of corporate dominance and American economic might. Not long ago, this asset was valued at roughly $205 million. It was a prime piece of real estate, the kind of safe asset that banks love to lend against and pension funds love to own. Recently, that same building was sold. In a transaction that should have sent shockwaves through every retirement portfolio in America, it sold for just $3.6 million. Let that number sink in. That is not a market correction. That is not a dip. That is a 98% loss of value. Nearly $200 million of equity and debt was wiped out in a single stroke. If you think this is an isolated incident confined to the Midwest, look to New York City. The prestigious tower at 1740 Broadway, situated in the heart of Manhattan, was once valued at over $600 million. It was recently dumped for less than $200 million. The lower tranche bondholders, the investors who financed that deal expecting a safe, steady return, got exactly 0 cents on the dollar. Their investment was completely vaporized. These are not anomalies. They are not the result of bad management at a single property or a specific bad neighborhood. They are the warning shots of a systemic collapse. We are witnessing the Great Devaluation, a mathematical reset of asset prices that the Federal Reserve is powerless to stop. The banking system is currently sitting on a mountain of these toxic loans, pretending that they are still worth the full amount. But the market has spoken. The truth is that hundreds of billions of dollars in bank capital have already ceased to exist. The only reason it has not been officially recognized is because the banks are refusing to acknowledge reality. I want to pause here and ask you a question. Are you seeing these for lease signs multiplying in your own town? Are the office parks in your city sitting empty? Please leave a comment below with your city and state. I want to map out exactly which parts of the country are witnessing this devaluation firsthand, because the news certainly won't tell us. Now, to understand the mechanics driving these collapsing prices, we must look at the catalyst known as the $1.5 trillion maturity wall. To understand why a $200 million building sells for $3 million and why this poses an existential threat to your savings, we must examine the mechanics of commercial lending. The American economy, particularly the real estate sector, runs on a refinancing machine. For the last 40 years, this machine has been lubricated by steadily falling interest rates. Developers and corporations borrow massive amounts of cash to buy buildings, often structuring these deals as short-term, interest-only loans with a massive balloon payment due at the end of the term. The plan was never to pay off the principal. The business model relied entirely on the assumption that when the loan matured, the borrower could simply refinance it into a new loan, likely at a lower interest rate. Today, that machine is broken. The gears have been stripped and the engine has seized up completely. We are now facing what is known in the industry as the maturity wall. In 2026 alone, over $1.5 trillion of commercial real estate debt is maturing and coming due for payment. This is an unfathomable amount of debt that must be refinanced in an environment that is hostile to borrowers. Most of these expiring loans were written during the free money era of 2020 and 2021, when interest rates were effectively zero. At that time, a developer might have secured a loan with an interest rate of 3% or less. The numbers worked beautifully on a spreadsheet. However, if that same developer walks into a bank today to refinance that debt, they are hit with a new reality. Rates of 7%, 8%, or even 9%. This immediately doubles or triples their monthly interest payment. It destroys the cash flow of the property instantly. But the interest rate shock is only half of the equation. We are facing a double helix of destruction. While costs are skyrocketing due to interest rates, revenue is collapsing due to a structural shift in the labor market. The work-from-home revolution that began in 2020 has calcified into a permanent change. Employees are refusing to return to the office 5 days a week, and corporations, looking to cut costs, are realizing they do not need to pay for acres of empty cubicles. Vacancy rates in major metropolitan areas have hit record highs, with some cities seeing 30% of their office space sitting empty. An empty building does not generate rent. Without rent, the landlord cannot pay the mortgage, no matter what the interest rate is. Commercial real estate is valued based on cap rates, capitalization rates, a formula that determines price based on the cash yield of the property. As interest rates rise, cap rates rise, which mathematically forces the value of the underlying asset to crash downward. This is why we're seeing 90% price cuts. It is just the cold, hard math of the new interest rate environment playing out. This situation creates a direct exposure for Main Street, trapping regional banks in a crisis of their own making. You might be asking, why does this affect me? I don't own a skyscraper in St. Louis. Here's where the story shifts from a real estate problem to a banking crisis that directly affects your life savings. We must ask, who lent the money to build these empty towers and deserted shopping malls? It was not largely the too big to fail banks like JP Morgan or Bank of America. After the 2008 crash, those giant institutions largely pulled back from this specific type of lending. Instead, the void was filled by regional and community banks, the banks with branches in your local grocery store, the banks that sponsor your local Little League teams. Regional banks hold nearly 70% of all commercial real estate debt in the United States today. During the low rate years, they loaded up on these loans because they offered slightly higher yields than treasury bonds. They chased yield, and now they're caught in a trap. These loans are turning into zombie assets that are eating the bank's capital reserves alive from the inside out. Consider the predicament of a local bank president. He has a $100 million loan on a building that is now worth only $20 million. He has an $80 million hole in his balance sheet. For a small regional bank, an $80 million loss could wipe out their entire equity buffer. It would make them technically insolvent immediately. So the bank is trapped in a nightmare scenario. They cannot sell the loan because no one will buy it at face value. They cannot foreclose on the property because if they take ownership, they have to realize the loss immediately on their books, which would shut down the bank. They are resorting to a strategy that Wall Street insiders call extend and pretend. They allow the borrower to skip payments or extend the loan maturity for another year, pretending that everything is fine. They simply refuse to mark the asset to its true market value, keeping it on the books at the old inflated price. This creates a ghost banking system where the financial statements you read are completely detached from reality. You might look at your bank's annual report and see a healthy institution with strong assets and minimal losses. But if they were forced to sell those real estate loans today, they would be bankrupt before the market closed. This brings us to the credit crunch that is currently strangling the real economy. Because banks are hoarding cash to prepare for these inevitable losses, they have stopped lending to everyone else. The loan officer survey from the Federal Reserve shows that lending standards are tighter now than during the 2008 crash. If you're a small business owner trying to get a line of credit to buy inventory, or a family trying to get a loan for a car, you know this pain. The bank will not lend to you because they are terrified of their own balance sheet. This sucks the liquidity out of the economy, causing a slowdown that leads to layoffs and a recession on Main Street. It is a silent crash because there are no dramatic news crews filming angry mobs. Everything happens digitally. Your loan application is just denied by an algorithm, and your credit limit is quietly slashed. Have you or a small business owner you know faced this recently? Have you tried to get a loan only to be met with unreasonable delays or rejection? Share your story in the comments. Your personal experiences help us build a true picture of the real economy that the official statistics try to hide. Unfortunately, the contagion is spreading beyond just office towers, infecting the multifamily sector and municipal budgets. The financial hemorrhage is not confined to the sterile glass office towers of Manhattan or San Francisco. It is spreading rapidly into the one sector of the real estate market that was supposed to be the safe haven for investors, the multifamily sector. I am talking about the apartment complexes and residential buildings that house millions of American families. During the speculative frenzy of 2021, a new class of investor entered this market, known in the industry as the real estate syndicator. These were aggressive investment groups that pooled money from doctors, lawyers, and retirees to buy massive apartment blocks at record prices. They bought these properties, assuming that they could raise rents by 20% every single year, forever. But the most dangerous part of their strategy was the debt they used. They did not use 30-year fixed mortgages. They used aggressive, floating rate bridge debt to maximize their leverage. These loans have interest rates that adjust every 30 days based on the Federal Reserve's benchmark rate. When they bought these buildings, their interest rate was 3%. Today, those same loans are charging 8% or 9%. The monthly payment has tripled overnight. The rental income from the tenants is no longer enough to cover the mortgage payment to the bank. This is called negative leverage, and it is the financial equivalent of bleeding to death slowly. We are seeing a massive wave of foreclosures in the residential sector, which will destabilize the broader housing market. When a 1,000-unit apartment complex goes into foreclosure, it depresses the value of every other property in the neighborhood. It triggers a chain reaction that hits the regional banks from a completely different angle than the office crisis. But there's a third front opening up in this war that is perhaps the most terrifying of all for citizens concerned about the quality of life in their communities: the collapse of the municipal tax base. Commercial real estate taxes are the primary source of revenue for massive cities like New York, Chicago, and Boston. When the value of an office tower drops by 50%, or 98% as we saw in St. Louis, the property taxes collected by the city eventually drop by a corresponding amount. This creates a massive budget hole for the city government, forcing them to make impossible choices immediately. They have to cut essential services like police, sanitation, and public transit to balance the budget. But cutting services makes the city dirtier, less safe, and harder to live in. This drives more people and businesses to leave the city, which lowers property values even further. This is the urban doom loop, a self-reinforcing spiral of decay that destroys the economic viability of a city. And who holds the municipal bonds that fund these cities? The exact same regional banks that hold the real estate loans. So the banks are getting hit on their loan portfolios. They are getting hit on their bond portfolios simultaneously. It is a systemic fragility that we have not seen since the 1930s. But the danger runs deeper than just bad loans. We must face the hidden risk of derivatives and the shadow banking system. Just like in the 1930s, the shadow banking system is exacerbating the crisis in ways regulators cannot fully see or measure. As traditional banks pulled back from lending in 2024 and 2025, unregulated private credit funds stepped in to fill the void. These are massive pools of capital managed by private equity firms that are not subject to standard bank regulations. They lent hundreds of billions of dollars to risky companies and real estate projects that banks rejected. Now, these private credit loans are starting to default at an alarming rate as the economy slows down. But unlike banks, private credit funds do not have to mark their assets to market value every quarter. They can engage in volatility laundering, creating a false sense of stability. However, eventually, the investors in these funds want their money back. We are already seeing redemption gates being erected by major real estate funds, like those managed by Blackstone and others, to stop investors from withdrawing cash. When you tell an investor they cannot have their money, panic sets in instantly. But the true monster lurking in the dark is the derivatives market. The true systemic risk to the global economy is not the office tower in downtown Chicago standing empty today. It is the quadrillion-dollar web of bets and insurance contracts tied to the value of that empty tower. When a regional bank lends money for a project, they often sell credit default swaps, CDS, or bundle the loans to sell to global investors. This spreads the risk like a virus. A pension fund in Europe might own the risk of a shopping mall in Ohio without even knowing it. This brings us to counterparty risk. A derivative is just a contract between two parties. If one party goes broke, the contract is worthless. If a regional bank sold insurance on a loan and then goes insolvent, the insurance is void. This creates a domino effect where the failure of a small bank can topple a massive hedge fund overnight. In the digital age, this failure happens at the speed of light. A bank run does not happen in line on the sidewalk anymore. It happens on Twitter and WhatsApp. We saw this with Silicon Valley Bank, where $42 billion left the bank in a single afternoon. Today, with instant payment systems, a bank can be solvent at 9 a.m. and completely drained of liquidity by 9:15 a.m. Regulators simply cannot react fast enough to save the institution. Crucially, we must address the widespread misconception that the Federal Reserve can simply print our way out of this trap, because this time, the rules of the game have changed. Many of you might be thinking, surely the Federal Reserve will step in. They saved us in 2008. They saved us in 2020. They have a money printer, and they aren't afraid to use it. This reliance on the so-called Fed put, the belief that the central bank will always floor the market prices, is the single most dangerous assumption an investor can make in this specific cycle. To understand why, we must recognize the fundamental difference between the crisis of 2008 and the crisis of today. In 2008, and again in 2020, the United States was enjoying a period of historically low inflation. The Fed could print trillions of dollars to plug the holes in bank balance sheets without immediately causing the price of bread and milk to triple. They had monetary headroom. Today, that headroom is gone. The inflationary fire that was ignited in 2021 has not been fully extinguished. It is merely smoldering. The Federal Reserve is now trapped in a checkmate position. If they pivot to cut rates and print money to save the regional banks and the commercial real estate sector, they risk reigniting inflation to double-digit levels. This would destroy the bond market, the very foundation of the global financial system, as investors demand higher yields to compensate for the devaluing currency. Rising bond yields would, ironically, further crush the value of the bank's assets, accelerating the very insolvency they are trying to prevent. On the other hand, if they stay the course and keep rates high to fight inflation, the maturity wall we discussed becomes a brick wall. The $1.5 trillion of refinancing fails, defaults skyrocket, and the banking system collapses under the weight of bad debt. They are damned if they do and damned if they don't. For the first time in 40 years, the Federal Reserve cannot simply print its way out of the problem because the currency itself is at risk. Furthermore, we must address the psychological component of this crisis, the normalcy bias. This is a mental state people enter when facing a disaster. It causes people to underestimate both the likelihood of a disaster and its possible effects. It is the reason why people stay in their homes during a hurricane warning, believing that because their house stood during the last storm, it will stand during this one. In financial terms, normalcy bias leads depositors to leave their money in insolvent banks because it's always been safe there. It leads investors to hold on to crashing assets because they always come back. But markets do not always come back. Just ask investors in the Japanese stock market, which took 34 years to recover its 1989 highs. Ask the bondholders of 1740 Broadway. I'm curious, do you have friends or family who still believe everything is fine? Who think you are doom and gloom for worrying about this? Let me know in the comments how difficult it is to have these conversations with people who are still asleep. This time, the structural breakage is real. The synergy of high debt, high interest rates, empty buildings, and a trapped central bank creates a perfect storm that no amount of positive thinking can wish away. The silent crash is not a temporary dip. It is a reversion to the mean, a painful correction of decades of excess that is necessary, inevitable, and unstoppable. We briefly touched on the speed of digital bank runs, but it deserves a deeper analysis known as the velocity of panic. In the 20th century, friction was our friend. To run on a bank, you had to physically drive there, stand in line, and fill out a withdrawal slip. This physical friction slowed down the panic, giving regulators time to calm the crowd or arrange a merger. Today, financial friction has been eliminated. In a world of banking apps and instant wire transfers, billions of dollars can move in nanoseconds. The crowd is no longer physical, it is virtual. A rumor on social media can trigger a liquidity crisis before a bank CEO even finishes his morning coffee. This velocity renders the FDIC's weekend takeover playbook obsolete. By the time they arrive on Friday night, the carcass has already been picked clean. This creates a binary outcome for depositors. You are either early or you are a victim. There is no middle ground in a digital panic. The liquidity is there one moment and it is gone the next, trapped behind a technical difficulties screen on your banking app. This inevitably leads us to the most uncomfortable reality regarding the resolution of bank failures, the threat of bail-ins and the limitations of the FDIC. Most Americans operate under the assumption that the FDIC, Federal Deposit Insurance Corporation, guarantees their money up to $250,000 and therefore there's nothing to worry about. While the guarantee exists in law, the mathematics of the insurance fund tell a different story. The FDIC's Deposit Insurance Fund only holds about 1% of the total insured deposits in actual cash reserves. It is designed to handle the failure of a few small banks here and there. It is absolutely not designed to cover a systemic collapse of the commercial real estate sector where dozens or hundreds of banks fail simultaneously. If the fund is depleted, the FDIC must go to the Treasury for a bailout. This means printing trillions of dollars more, which debases the currency and creates an inflation loop that destroys your purchasing power. So even if you get your dollars back, they will buy significantly less at the grocery store. However, the government has been very clear that they have no appetite for future taxpayer-funded bailouts. This is why we must understand the concept of the bail-in. Under the Dodd-Frank Act and international banking accords, the law allows for failing financial institutions to be recapitalized not by taxpayer money, but by the bank's own liabilities. In legal terms, your deposit at a bank is not your money sitting in a vault. It is an unsecured loan you have made to the bank. You are a creditor. In a bail-in scenario, unsecured deposits can be legally converted into bank equity. This effectively turns your cash savings into worthless stock in a failed bank to keep the institution afloat. This happened in Cyprus, it happened in Greece, and the legal framework exists for it to happen here. The maturity wall of 2026 is the potential trigger that could activate these bail-in protocols for the first time in U.S. history. Given this grim analysis, the most urgent question becomes how to execute a plan for protecting your wealth. Given this grim analysis, the question remains, what do you do? How do you protect the wealth you have spent a lifetime building? The first step is a psychological shift. You must acknowledge that return of capital is now infinitely more important than return on capital. This is not the time to chase a 5% yield if it puts your 100% principal at risk. The first essential step is diversification to ensure you remain within FDIC limits. You need to move your money out of the blast zone of the regional banking system. If you have more than $250,000 in any single institution, you're taking a risk you simply do not need to take. Split your funds across multiple banks to ensure every penny is covered by federal insurance. Do not rely on the bank being too big to fail. For those with larger sums, the second step is to become your own central bank by utilizing treasury bills. For larger amounts, or for those who do not trust the solvency of the insurance fund, you need to exit the banking system entirely. This does not mean stuffing cash under a mattress. It means holding bearer assets that have no counterparty liability. Short-term U.S. Treasury bills, T-bills, are the most direct way to lend money to the government, bypassing the bank in the middle. You can buy T-bills that mature in 4 weeks or 3 months. In a banking crisis, T-bills are considered pristine collateral and are often more liquid than cash deposits. Beyond government paper, the ultimate hedge against systemic failure is physical gold and silver. You should observe what the central banks of the world are doing, not what they are saying. Central banks in China, Russia, and Europe are buying gold at record rates. They are repatriating their gold reserves to their home soil. They are de-risking from the dollar and the banking system. Gold is the only financial asset that is not someone else's liability. It has survived every banking collapse, hyperinflation, and war in human history for 5,000 years. Allocating a portion of your portfolio to physical precious metals provides a hedge that cannot be erased by a computer glitch, a bank holiday, or an algorithm. Finally, to survive the coming wealth transfer, you must aggressively eliminate personal debt. Finally, you must look at your personal debt exposure. If you have a variable rate mortgage or high interest credit card debt, pay it off immediately. As banks tighten lending, they will raise rates and slash credit limits. You do not want to be at the mercy of a desperate bank that needs to squeeze you for cash flow. We are entering a period of massive wealth transfer from the indebted to the liquid. Those who have cash and no debt will be able to buy distressed assets, like that St. Louis skyscraper, for pennies on the dollar. In conclusion, friends, the data implies that the math simply does not work. The $1.5 trillion maturity wall is real. The vacancies are real. The bond losses are real. The insolvencies are documented. We are watching a slow-motion train wreck. The mainstream media will tell you the system is sound right up until the moment it fails, just as they did with Silicon Valley Bank on the Thursday before it collapsed on Friday. Do not be the greater fool who leaves their life savings in a vulnerable institution out of habit or inertia. The window of opportunity to move capital freely is still open, but as we have seen in history, during times of crisis, capital controls and bank holidays can slam that window shut overnight. Take control of your financial destiny today. Review your accounts, diversify your holdings, reduce your debt, and most importantly, stay informed. Finally, I have one request. If you found this analysis valuable, please type "I am preparing" in the comments below. It is a small gesture, but it lets me know that this message is reaching the people who need to hear it. And please, share this video with one person you care about. You might just save their financial future. Thank you for your time, and thank you for being willing to look at the hard truth, no matter how uncomfortable it may be.